Hello and welcome back to the show, everyone. I'm your host, Levi with Mailbox Money here in Sioux Falls, South Dakota. And today's guest is John Casmon. John is the marketing partner of Casmon Capital Group, a multifamily real estate investment firm that helps busy professionals build wealth through apartment investing. In addition to leading Casmon Capital Group, John is also the host of Multifamily Insight podcasts and a coach for multifamily investors looking to grow their wealth and business. John, welcome to the show.
Absolutely. Hey, thank you for having me today.
Yes, sir. We are excited to have you here and to learn where your journey has brought you to today. But let's kind of start at the beginning, letting people know who you are, where you come from, and all that good stuff.
Yeah, I mean, today, I'm a multifamily investor. I've invested over $150 million worth of apartments working with everyday professionals. But I didn't start that way. I was in corporate America. I did that for 15 years. I worked in
Yep.
advertising and marketing. And I was at two companies that went through bankruptcy. So I watched, my stable career kind of, not necessarily go up in flames, but I watched the floor underneath me get pulled and figured out I better figure, I realized I need to figure out a plan B. And that kind of led me to real estate. Like many of your investors, I, read a lot of books and listened to podcasts and try to educate myself as best as I could. But ultimately started to invest and slowly started to build my portfolio. Had some wins, had some losses, had some hardships, overcame all those things, and ultimately been able to build up this portfolio and continue to grow and scale and navigate the various challenges that investors face.
Very good. I'd like to kind of maybe touch on a little bit more your mindset at the time of
Yeah.
being in corporate America and going through. I'm assuming, like a lot of people, you hear why you have the W-2 job and everything is the security side of things. And you said that you ran into twice that maybe more secure thought when in a bankruptcy. And walk us through your kind of mind frame at that time in your life.
Yeah, so I mean, the first time I was pretty early in my career, it was 2008. I was really in my career for just a couple of years at that point. But I was working at General Motors. I'm downtown Detroit headquarters, and I'm watching my company become the face of what ultimately was a great, the latest recession there. And you didn't know it at the time. It started off as just something that was happening in our company. And slowly we started to realize this is actually the automotive industry. And then after a few months, that's when we realized, hey, this is actually impacting the financial industry as well in the country as a whole. But starting out, I mean, I remember watching, our CEO fly down to DC and get just, ran, just they dragged him through the mud,
Through the
and
meat grinder, right?
that was the last time we saw him in a public forum. And I remember watching my boss's boss become the new face of the company. So whenever there was any kind of media opportunities, she would be on there. And there was one day I'm asking, "Hey, how's it looking? Are we going to be okay?" And she's like, "Oh, you're fine. Just keep your head down and do your thing." And 3 hours later, she's on like CNN or Fox News or something, and she's talking about the state of the business. And if we don't sell 16 million vehicles as an industry, we're going to go bankrupt. And I'm like, whoa, that is very different from keep your head down and do your job.
Yes, it
So
is.
I just remember, man, just anxiety every day, just anxiety. The mood was rough. I mean, no one wanted to address the elephant in the room. And there was one guy who was happy, man. He came in, same great energy he had from day one. And I remember one day asking him to get coffee. And we went downstairs, we grabbed coffee, we were just chatting. And I'm like, hey, man, like everybody here is like walking on eggshells. And you are coming in here singing and damn near skipping. Why? And he was like, oh, well, I enjoy what I do, but I don't need this. He's like, I've got some investment properties and they, pretty much are covering my retirement. I got a pension here. I got this. I got that. I do this because I like it. And that was the first time I really opened up my eyes to one, just taking control of your financial future beyond the job. Up to that point, I just thought you worked your job, you put in your time, you get your gold watch, you retire, you got your 401k or your pension or whatever you got, and that's what you did. So that opened up my eyes to this logic company obviously went through bankruptcy. I actually survived and I was fine through bankruptcy. It actually gave me an opportunity to grow and scale what I was doing, but it never shifted the responsibility of like you need to take control over your own financial future. So I learned about real estate investing, mainly because I wasn't savvy from a technology standpoint to figure out the next great app. So I was like, well, I better figure out something
You and
that's a
me
little more
both there.
achievable. And real estate felt like it was that thing. So like others, I started with smaller portfolio, duplex, bought that, did really well with that first investment property. Went and bought a 3 unit building that did great. And then I went to buy an 8 unit building, bought that, and two things happened. One, I was actually saddened because all I could think about was, man, it's going to take me like another year and a half before I could save up money to buy another property. And then the
Mhm.
second thing is that second company I was working with, I had left, moved to Chicago when I was buying these properties, but that second company ended up going into bankruptcy completely out of the blue. I mean, and the difference for me was like GM, we kind of saw it coming 9 months before it actually came. I mean, we were
There
kind of
were
going through the
signs.
pro. There were not just signs. I mean, it was on TV. I mean, this was it was nationally
Reporters
broadcast
talking
signs.
about it.
Yeah, yeah. So I mean, it was the talk. Right? If you remember that election period, that was the whole thing. They were saying, "What are you going to do? Are you going to bail out the banks? Are you going to bail out the automotive industry?" So that was a part of the election cycle. So once
Yes.
that happened, there was a structured bankruptcy. The second time I was working at an agency, there was none of this. It was literally a day. I got a phone call and I wasn't, fairly high up, official at that point. And I got a phone call from a New York office saying like, "Hey man, the bank, somebody's here seizing assets. What's going on there?" And I'm like, "What the hell are you talking about?" So I called the CEO and he didn't know what I was talking about. And he's like, "Oh, let me call you back." Dude, within days, this company had vanished. It just didn't exist anymore. And that was the straw for me. And what I realized is I had the right strategy with real estate investing, but the way I was investing in real estate was not sustainable because it was only tied to how much capital I had available at any given moment in time. And like
Yeah,
everyone,
absolutely.
I don't care how much money you have, you have millions and millions and millions, you are still limited based on your capital and the resources you have available. So you have to learn about leverage and OPM or other people's money or partnerships. And that really opened me up to a new strategy and ultimately led me to partner with others on these apartment deals.
Amazing, amazing. So, kind of just to put a bow on that story is you saw a gentleman living the life that you were hoping to have, and you opened it up with the conversation and figured out what he was doing, and that changed your whole world, huh?
Yeah, man. It's interesting how at that time, I didn't see it as like an instrumental, moment in my journey. But looking back, I can see it was pivotal because you're in this, I mean, picture, um, think of the Titanic, right? In the Titanic, or at least in the movie, the way it's depicted, everyone's panicking, but the band is still playing as the ship is
Yeah.
going down, right? It was kind of like that. I'm looking at this dude like, bro, don't you realize this boat is sinking? And he's just, happy and doing his thing. And, he basically was like, I have a life jacket, man. I'm good. I have my own
Yep.
mini, I got a life jacket. I got a boat. I'm gonna be okay. I'm just hanging out here with you guys. And that was kind of how I saw it. I'm like, you know what? You need your own life jacket. You need your own emergency boat because at any given moment, it can be taken away. And being at a company like that, you can imagine there was so much um, positioning and politicking when times were good, yet alone in this crisis situation, right? Because everybody wants the next promotion, everybody wants to be next to this guy, and I mean, again, you have a lot on the line there, playing that corporate game. So for me, I just had a lot of time to process, like, okay, do I really want to play this game for the rest of my career? Is there a
Mhm.
different game? Do I want to just do good work and not focus on kissing this guy's ass or being seen as too close to this person here, which was kind of what you had to do. And I just really took a step back and said, "Be like Jack." This guy's name is Jack, and I'm like, not the movie Jack.
That I was gonna say, you're
My
going
guy's
back to
name is Jack.
Titanic.
Not that guy, Jack. That guy sunk and died in the water. Jack
He
was
could have
my old
made it on the.
colleague.
He could have made it on the
He
plane.
could have made it
She
on there,
needed
right?
made a scoot
That's
over,
a
right?
whole other thing, right? Derailing the conversation, but yeah, but that's it, man. Just having control over your career, and it doesn't mean it's going to go swimmingly. There's still going to be ups and downs and challenges, but at
Of
least you're
course.
the one who's in charge and not relying on someone else.
Yeah, let's fast forward to today, how you're educating and helping others follow kind of your exactly the footsteps you walked in.
Yeah, I think the biggest thing, man, is just sticking true to the fundamentals. It's very easy to get caught up in the trends and what's working and oh my goodness, right? Like you don't want to miss out on opportunities and there's FOMO. And I think that happened a lot over the last few years. And what has happened because of that is a lot of people started to pivot and do different things or change their strategy. But the truth is the blocking and tackling, the fundamentals of real estate investing have never changed. And we have become victims of interest rates and again these swings in the economy, and maybe we've lost sight of the fundamentals. So for me, I'm in the Midwest. I know you're out in Sioux Falls. The Midwest doesn't operate like the rest of the country. Our highs are not as high, our lows are not as low. We really do have to factor in the stable environment, more conservative rent growth estimations, things like that. So for us, what we're focused on in our business is really the fundamentals of investing. What we try to teach other folks is the fundamentals of investing and not to sway too far away from that. Now, as you develop your expertise and you know exactly where you have a competitive advantage, by all means, you should lean into that. But what's happened is so many people started to try to make deals work and they forced the numbers, they forced the deals, or maybe they just weren't as conservative or didn't pay as much attention to the downside where we've lost sight of things. And the simplest way I can look at this is cash flow, buying a property for cash flow. And we we think it's paramount. You buy for cash flow, you drive and you operate, you push for appreciation and the upside potential. But it's got to make money out of the gate. And so many times people don't factor in the expense growth items, insurance costs, taxes, or debt service, right? Loans shot up,
Yep.
interest rates shot up, and that hurt so many people when it comes to these deals. So you just have to really focus on those fundamentals. There's a lot of nuance involved where it comes to understanding your market. So we do a lot of trainings on that. We do a lot of webinars. We've got our coaching community. We just launched a free Facebook group to share more information. But we try to just share as much as we can on our experiences and the things that we have seen stay true going back to the last economic downturn to present day.
Of course. And kind of like you mentioned before, getting into this game, you don't have to have all the answers yourself. Leaning on the, of course, you have the other people's money on the capital side, but just the knowledge part of it, building a team or taking advantage of a team that's already out there that has seen all the different ups, downs market. And like you said, with Midwest here being a little more steady Eddie, we can get more on track on those fundamentals and follow those along.
Yeah, and that helps a lot. Not, I'd be remiss if I didn't acknowledge all the help I had along the way, right? And one of the biggest
Mm.
things I think any investor can do is you've got to find mentors, you've got to find partners, folks who can help guide you through the process. And I had a ton of them, and I was able to take some of the best lessons from some, identify this guy's really, really great at this, or this woman's really phenomenal at that. And I was able to take some of that and kind of craft my own logic and my own thinking based on that information. And when I talk about the fundamentals of investing, the reason I think this is so important is because people who have come into investing more recently, they they operated under the belief that this was almost like a guarantee
Yeah,
and that you couldn't mess up or real estate always goes up in value. And that's just not true. And most of us understand that, but it didn't feel that way. And when you only see other people winning, then you think, oh, this must be how you do it. And I think it can be very dangerous for folks, and we're starting to see some ramifications of that now.
absolutely we are.
But you also don't want to go 180 where now you think, oh, real estate's bad, syndications are bad, or anything like that. It's not. You have to look at the deal. You have to look at the logic, the strategy. You have to understand the time frame, the market. Like all of these things matter. It's the same way if you're investing in anything else. You can't just throw money out there and expect it to go up. Some people are used to thinking that way. They put their money out there and they expect it to go up. Well, it depends on where you put it at, right? If you didn't put in the right place, you didn't ask the right questions, you didn't evaluate the opportunity, you didn't understand it, then it may not go up. So just asking better questions, I think, is absolutely critical. It was one of the reasons we put together our guide. It's a free guide. It's 7 questions you must ask before investing in apartments. It's really rooted in apartments, but the logic I think applies to various asset classes. So those are the kind of things I think are really important. Is just educating ourselves and challenging ourselves, but also taking ownership ourselves of our own education and our own investments. It's very easy to point the finger and blame someone else for, maybe being a bad operator or maybe losing money on a deal. And I'm not removing responsibility from that individual,
Mhm.
but I do think it's really important for us to understand our own investing thesis, our own investing criteria, our own risk tolerance, and finding the right investments that match what it is we're looking to do, recognizing and acknowledging that every investment has some level of risk to it. So, based on your return profile, maybe you don't want to do certain types of deals, or maybe you need to be more aggressive in the kind of deals because you want a bigger payout. That's all a part of investing. And I think people didn't see real estate investing as truly investing. They saw it as, like, again, more of a guarantee. And that was really never the case.
Yeah, my boss Dustin Hendrickson, he always like for a little bit people were thinking real estate was a get rich quick type thing, or really real estate is a get rich slow kind of play.
It's
And
always been get rich slow. And but to your
yep,
point, I mean, people got spoiled. I mean, they were getting in deals and
exactly.
within 18 months doubling their money. And I get it, but that was never sustainable.
Exactly, exactly. And I think, like you said, we've the past couple of years kind of been seeing the ramifications of the quote unquote bad operators and teams, and that they've been now exposed with what the market's doing versus who's actually following back to, like you said, the fundamentals, sticking to what's worked throughout many decades and sticking to those and holding their guns.
Yeah, and I'll just call out, man. I'm probably overly sensitive to this, but um I don't like to take shots at somebody when they're down or because something didn't work out. I mean, some of those guys crushed it for their investors for a few years, man.
Yeah.
And I know those investors were very, very happy when they were doubling and tripling their money on 18 or 24 or 36-month hold. So I don't want to now turn around and you know dance on what they were doing. That's not my intent, right? I think as investors, there's always some level of risk. If you're willing to ride that wave with those kind of opportunities, then hey, ride it. But that's part of it, right? That's part of the process.
Mhm.
Is you gotta deal with the dips as well. Our strategy has just been more has we don't like the ripples as high, right? So we are looking for something a bit more sustainable. Maybe it's less sexy, maybe it doesn't have the same upside. But we're not flawless in that either, right? And we always learn, we always try to get feedback, we always try to adjust our approach. But the strategy for us and our kind of our guardrails, that's remained pretty consistent over time. So again, I think for every investor, you have to decide what are you looking for? What is your risk tolerance? And then what types of operators, what types of investment match your criteria?
John, for our listeners who are thinking about, alternative, but maybe they've just like yourself at the beginning, just believed working hard, putting money in their 401k. What kind of advice would you give that listener to maybe start considering nowadays?
The biggest one is this, man, play the long game. And what I mean by that is I had a great conversation with a guy named Steven Pesavento. And Steven and I were just chatting. And if you think of investing as a game, you don't like stop playing a game because something bad happened or you didn't get the results you were looking for. So let's use a sport as an example, right? You're playing football. If you fumble in the second quarter, you don't take off your helmet and start shaking hands and walk to the locker room, right? Like, you still got 2.5 more quarters to go. You keep playing, you learn from that. Well, why did I fumble? Let's try to play defense. Let's get the ball back. Even if we give up a score, okay, hey man, let's go get it back, right? The objective is to win the game. It's not to never fumble. And what happens with a lot of investors is they have something negative that happens, and now they no longer want to play the game. So if you are investing for financial freedom, if you want to have more time to travel, or you want to retire early, or whatever the case may be, the goal doesn't change. The strategy, the tactics, the things that you do to get there, absolutely. That's a turn. You made this investment, either it panned out and got you closer to the goal, or it took you back 2 steps. That's how you need to look at investing. You don't necessarily need to put your view of yourself into the actual investments. Learn from it. You got to reflect and you got to get better. But on the same note, what happens a lot of times is someone makes an investment, it doesn't go well, and they say, oh, real estate doesn't work, or hey, you shouldn't invest in apartments, or hey, syndications suck, or whatever the case may be. No, that term just didn't work. If your goal didn't change, let's adjust what happened, let's learn from it, and let's make better investments moving forward. But that's not going to change your ability to retire early. That's not going to change your desire to, leave a legacy for your family. So you need to continue to find the plays or the turns that get you closer to your goal. So having that mindset and gamifying investing, that really alleviates, I think, some of the concern or the image that we put onto the actual investment as a reflection of who we are as people and as investors. Just separate it, man. It's a game, right? And yes, it sucks because it's real money, but on the same note, you're trying to get to an end game, right? Some are going to work, some are not going to work. You want to have more of that work than don't work. Continue to work, refine what it is you're investing in, what your investing thesis is, and ultimately keep striving to win the game.
Amazing. John, would love to hear what you kind of have on your horizon here, maybe the next year and kind of 5 year goal. And then I also would love to give you the opportunity to shout out places where people can find you, learn more about you and what you're working on, sir.
Yeah, I mean, the biggest thing for us is really taking a small step back and saying, okay, hey, some of the we just talked about the game, right? So the game for us doesn't change. We know what success looks like. However, we've realized, hey, you know what? We might need to try some other things other than just this one approach, right? So we're starting
Mhm.
to diversify from just being apartment investors. We bought some mixed use properties. I've got a medical office facility. And what we realize is, hey, we're really great at building relationships and connections. How do we take that and create the right opportunities, particularly in our backyard? So we're starting to diversify that, the kind of deals we go after. We still want the same returns. We still want cash flow. Like that guardrail has not shifted and will not shift, but the type of asset itself can be a bit more fluid as far as what we're looking for. So for us, it's really about finding great opportunities to bring investors along with, where we feel like we have more control on the business plan and the execution of that business plan and growing our portfolio from that standpoint. As far as opportunities, we have our podcast called Multifamily Insights. It's available anywhere you listen to podcasts. And we do have a number of resources available on our website. So you can go to casmoncapital.com. We have our 7 questions guide, which is available casmoncapital.com/7 questions, as well as, a number of other resources. But if you go to our website, there's a drop down, I think, called resources. So you'll see a few things there.
Perfect. We'll make sure to have links in that in our episode description for our listeners to check out as well. Well, it's coming to the end of our show here, John. I got to thank you. I love you brought in not only my love of sports, which most people share, but my love of movies. And that's kind of a rarity that I get people making Titanic
I was not
analogies on the
expecting to
show.
make that analogy, so here we are.
Amazing. Well, thank you again for your time, sir. The people are going to like this one and get a lot of value out of it. So appreciate you.
Absolutely. Thank you for having me today.
Of course. Thank you guys for listening to this, and we'll see you on the next one.